This April, the state pension rose by £574.60 a year. The personal allowance rose by £0, and the gap between them, the gap that decides whether your state pension itself becomes taxable, is now £22. There are 5 quiet shifts already moving through the pension system right now, 3 of them legislated, 2 of them already changing how people behave. Most people will only notice them when it's too late to plan. So today, I'm walking you through all 5, calmly, precisely, with the actual numbers from gov.uk. I'm Helen Hartley. For 32 years, I worked inside the UK pension industry as a chartered financial planner. The changes I'm walking you through today aren't speculation. They are dates on the calendar: 2026, 2027, 2029, 2031. So let's begin with the smallest number on the list. Rule 1. The £22 trap. Consider the maths. From this April, the full new state pension is £241.30 a week. Over the year, that's £12,548. The personal allowance, the amount you can earn before income tax starts, is £12,570. Take one from the other, £22. That is the entire tax-free space left in the system after your state pension has been paid. If you have a state pension and any other income, a small private pension, bank interest, a part-time wage, anything over £22 for the whole year, you are an income taxpayer. Not next year, this year. The state pension goes up every April under the triple lock. This year by 4.8%. The personal allowance hasn't moved since 2021. So every triple lock rise pushes the state pension closer to the allowance and the gap closes a little more. Here's the part that hasn't yet hit the headlines. The Low Incomes Tax Reform Group, that's an arm of the Chartered Institute of Taxation, has now stated publicly that they expect the full new state pension to exceed the personal allowance from the 2027/28 tax year onwards. From April 2027, the state pension on its own, with no other income at all, will start generating an income tax bill. Not because the pension grew too generous, because the threshold beneath it stopped moving. So if you're approaching state pension age, or already drawing it, there's a small action that takes 5 minutes today. Check your tax code on your most recent payslip or pension statement. Make sure HMRC has the right figure for your state pension going forward. Rule 2. The freeze that quietly raises everyone's tax bill. The personal allowance has been frozen at £12,570 since 2021. The higher rate threshold, where 40% tax begins, has been frozen at £50,270. At the autumn budget in November 2025, the Chancellor extended that freeze all the way to April 2031. No rate change, no new tax, just a longer pause on numbers that should have been moving with inflation. Here's why that matters. The Office for Budget Responsibility, the government's own forecaster, estimates that this freeze alone will raise an extra £55.5 billion in the 2030/31 tax year, not over a decade, in 1 year. The OBR also estimates that 700,000 more people will be paying income tax by 2030/31 who otherwise wouldn't. This is the mechanism the Treasury calls fiscal drag. Inflation pushes wages, pensions and savings income upwards. The thresholds beneath them stay still, so more of your income gets dragged across into a tax band that in real terms shouldn't have caught you, No headline tax rise, just more pensioners and more workers paying tax each year. The action here is awareness, not panic. If you have a workplace pension, a small private pension, ISA dividends, or rental income, ask yourself, is any of it likely to push you across the £50,270 line in the next 5 years? Once you cross it, the tax on that next pound jumps from 20% to 40%, and the threshold isn't moving until 2031. Rule 3. The salary sacrifice clock that's already ticking. Salary sacrifice, sometimes called salary exchange, works like this. Instead of being paid your full salary and putting some of it into your pension yourself, you take a smaller salary and your employer pays the difference straight into your pension. Because the money never officially becomes your salary, neither you nor your employer pays national insurance on it. With employer NI at 15% and employee NI at 8% on most earnings, this arrangement has saved both sides real money year after year. That ends in April 2029. At the November 2025 autumn budget, the Chancellor announced, and the legislation has now been introduced to Parliament, that from the 6th of April 2029, only the first £2,000 of salary sacrifice into your pension each year will remain free of national insurance. Anything above £2,000 will attract employee and employer national insurance, just like normal salary. The Office for Budget Responsibility expects this single change to raise £4.7 billion in its first year alone. Around 7 to 8 million workers currently use salary sacrifice in some form, and roughly 3.3 million of them, about 44%, will be affected by the new cap. Here's the part to focus on. There are still 3 full tax years between now and April 2029. If you're using salary sacrifice for amounts well above £2,000 a year, this is a planning window, not a panic. It's worth checking what your current annual sacrifice figure actually is and what your remuneration looks like once the cap takes effect, with your employer, your payroll team, or an FCA-regulated advisor. Rule 4. The biggest structural change to UK pensions in a generation. For most of the modern pension era, your pension pot has sat outside your estate for inheritance tax purposes. If you died before drawing it down, your beneficiaries received it without inheritance tax being applied. From the 6th of April 2027, that ends. Announced at the 2024 budget and confirmed in detail at the 2025 budget, most unused pension funds and lump sum death benefits will be brought within the value of your estate for inheritance tax. The inheritance tax nil rate band stays at £325,000. The residence nil rate band stays at £175,000. So the threshold doesn't move, but the size of the estate being measured against it just got bigger. Here are the numbers from gov.uk's own impact assessment. Around 213,000 estates with inheritable pension wealth are expected in 2027/28. Of those, 10,500 estates will face an inheritance tax bill where there would not have been one before. The average extra inheritance tax bill, where pension assets are now included, is around £34,000, and there's a second layer most people miss. If you die after 75, the beneficiary who inherits your pension also pays income tax on the money when they draw it, inheritance tax at 40% on the way out of the estate, then income tax at the beneficiary's marginal rate when they take it. Combined, that effective tax rate on inherited pension wealth can land between 64 and 67%. If you have a meaningful pension pot, a property and adult children, it's worth, sometime in the next 12 months, having a proper conversation with an FCA-regulated estate planner about what your estate looks like under the new rules. Rule 5. The trap that's already caught tens of thousands of people. The first 4 rules are about future dates: 2027, 2029, 2031. This one is about right now. In the run-up to the November 2025 budget, the Financial Conduct Authority's data shows £70.9 billion was withdrawn from UK pensions in the 2024/25 tax year, up 36% on the year before. But the figure that really tells the story is tax-free cash. £18 billion of pension lump sums were taken in 2024/25, up 61% on the previous year. Between October 2024 and March 2025 alone, 111,000 people accessed their tax-free lump sum. Why? Pre-budget rumours that the 25% tax-free lump sum might be cut, and the inheritance tax change announced in the 2024 budget. So people moved. Imagine someone, let's call her Janet. Janet is 64. Last autumn, the rumours got loud enough that she rang her pension provider and took her full 25%, £75,000, in tax-free cash. She put it into a savings account at 4% interest. The budget came. The tax-free lump sum wasn't touched. Now Janet has a problem. She can't put the money back. HMRC's rules on what they call pension recycling are strict. If it looks like the cash was withdrawn intending to recontribute, the penalty can be up to 55% of the amount recycled. So her £75,000 sits in a savings account, generating taxable interest, no longer compounding inside her pension wrapper, and now sitting inside her estate for the 2027 inheritance tax change too. Rathbone surveyed pension savers earlier in 2025. 27% of people who had withdrawn a lump sum said they regretted it, and only 30.6% of pension plans accessed for the first time in 2024/25 were taken with regulated financial advice. The action here is the simplest one in this whole video. Don't let a budget rumour move your pension. If you have a clear, planned reason to take your tax-free cash, that's a different conversation. But if the only reason you're considering it is, what if they change it? Pause. Speak to an FCA-regulated advisor. Because the changes that are actually coming are already on the calendar. The £22 trap is here this April. The threshold freeze runs until 2031. The salary sacrifice cap lands in April 2029. The inheritance tax shift hits on the 6th of April 2027. And the panic withdrawal trap is catching tens of thousands of people right now. None of these are speculation. They are dates on the calendar. And the people who plan around them, calmly with proper advice, are the people who keep the money they've worked their whole lives to build. If this helped you today, send it to a friend who needs to hear it. I'm Helen Hartley. Hit subscribe so you don't miss the next rule they aren't telling you, and I'll see you there.